Good evening, everybody. Uneducated Economist here. So, one of our viewers, Chofo Show, he asked us, why are mortgage rates dropping and is that good or bad for the economy? Well, short answer, why are mortgage rates dropping? Because somebody's buying U.S. Treasuries. Banks use U.S. Treasuries as their basis for loans, right? They can either loan money to the U.S. government, which is like the most secure guarantee, definitely going to get you money back kind of loan, or they can take out a little bit of a risk and loan it to you and me for a higher interest rate. So if U.S. Treasuries drop, then mortgage rates will drop as well. Now, who's buying up these U.S. Treasuries? Well, if you go to usdebtclock.org and you look at the foreign purchases of U.S. Treasuries and you look at how many Treasuries are being issued right now, you're going to see that the foreign purchases of U.S. Treasuries is like 4-to-1 to the amount that are being issued right now. There is a huge amount of outside foreign purchases of U.S. Treasuries. Now, the U.S. government just loves this because they, if they're issuing like $100 worth of U.S. Treasuries and there's $400 worth of buyers, interest rates are going to be incredibly low for that, right? So they get to issue out their debt at a low interest rate. Well, the Federal Reserve loves this as well because they're trying to unload their balance sheet, which is full of U.S. Treasuries, right? But when they unload their balance sheet, what they do is they're competing with the U.S. Treasury itself, and they usually ends up causing interest rates to rise. But if you have a whole bunch of foreign buyers out there, now they can unload their their treasuries without causing interest rates to rise since they have an influx of buyers for them, okay? So what is this doing to the economy? Well, I guess it's good for the guy who's looking to take out a loan right now, right? You can get an interest rate on a loan that's really low, or at least the premium that you would pay on it. But if this continues, what's going to end up happening is that the Federal Reserve is drawing, every time they unwind their balance sheet and allow those treasuries to come off their balance sheet, they're drawing Federal Reserve notes back into the Federal Reserve, which is the paper dollars that we use. See, during quantitative easing, they printed up dollars, adding money to the liquidity, adding this pool of liquidity to get bigger, right? That means there was more dollars out there for us to go and compete for. Wages get to go up, assets get to go up. This is where the growth comes in. But as the liquidity shrinks, that means we have to compete ever harder for those dollars. That's a dollar strengthening taking place right there, right? So as the pool of liquidity gets smaller and smaller, you and I have to compete harder and harder to try and get those dollars. That means like if you get laid off, the next job you take may end up having to pay a little bit less than the one that you were doing, or you may end up having to work harder for the same amount of pay. Something like that because the dollar keeps strengthening up. So if you take out a loan right now, yeah, you might be getting a really good low interest rate on your house or whatever because of this, unique situation where we have this influx of buyers into the U.S. Treasury. But over time, if the Federal Reserve continues to strengthen up those dollars and by taking the liquidity off the market, which they plan on doing until September, the dollar that we compete for is going to get stronger and stronger, making it more difficult to actually pay back that loan, right? Because you're going to have to work harder to get because the dollar isn't going to change to your house, so you're going to have to pay an ever-increasing, strengthening dollar back for, an overinflated house, essentially. And there's two things happening there, right? The Federal Reserve, who, typically when they were buying U.S. Treasuries, they were adding money adding liquidity to the market. Well, foreign purchases of U.S. Treasuries is actually taking money out of the market, right? Because pretty much what they have to do is they're scared of their own currency, right? You got somebody over in the Eurozone who's looking at their dollars, their local currency, going, oh crap, the central banks are going to be printing up money and weakening our dollar. We need to get out of our dollar and into a stronger dollar, which is the U.S. dollar. So what they do is they take their money, their local currency, and they buy U.S. dollars with them and then go and purchase the U.S. Treasuries with that, okay? So that little move right there is adding strength to the dollar, right? So you have two different moves causing interest rates to go down at the same time a strong dollar taking place. Anyway, I find that very unique. Goes along with the milkshake theory. If you guys aren't familiar with the milkshake theory, you should take a look at that one. I did a couple of videos on it, but it very much plays into that. Anyway, Uneducated Economist, you guys, I'll leave a link down in the description and you guys will let me know. All right. Hope you guys have a great evening.